Making smart penny stock picks. Penny stocks, as the name implies, are equities of companies that trade at a cheap share price, frequently less than $1. Given the low share price, there is a natural appeal for individual investors who dream of purchasing 10-cent shares and watching them climb to 10 or more times that amount. Hello everyone, and welcome to a brand new video on the channel. Today, we are going to talk about making smart penny stock picks. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Share the price and valuation. One of the most common misconceptions among retail investors is that penny stocks are inexpensive. There is a notion that purchasing thousands of shares rather than a few of a company with a higher share price provides a better return on investment. At first glance, this logic appears reasonable. After all, a $1,000 investment in Company A, which trades at $0.10, permits the investor to purchase 10,000 shares rather than 10 shares of Company B, which trades at $100. The number of shares outstanding is an important piece of information that is often missed. Assume that Company A and Company B have similar fundamentals, with the exception of the number of outstanding shares. To simplify, let us assume that both companies have a market value of $100 million. When the share price is the only thing considered, a retail investor may believe that the quality of the firm dealing at $100 is far higher than the one trading at $0.10. As demonstrated in the example, this may not always be the case because they are identical, so it is critical to evaluate the number of shares available. Beware of dilution. Dilution is another important consideration when trading penny stocks. Employee stock options, share issuance to raise cash, and stock splits can all lead to an increase in the number of outstanding shares. The ownership percentage of other investors frequently decreases when a corporation issues shares to raise capital, as many small businesses must do. For example, if Company A issued an additional 110 million shares in an effort to raise funds, the share price would naturally fall to $0.09. $0.09 maintains the market value at $100 million. In this situation, the basic business remains unchanged. However, the number of shares has increased, resulting in a decrease in the share price. When trading penny stocks, it's critical to discover a company with a solid understanding of its share structure, as repeated dilution reduces the value of shares owned by existing owners. How to spot a possible winner? As was demonstrated earlier, the majority of businesses that trade with share prices that are less than $1 have market capitalizations that are quite low. However, this does not necessarily have to be the case. When it comes to investing, it is essential to take into consideration the level of strength that the fundamentals of the firm have. When it comes to raising cash, does the management team rely on the issuance of additional shares? Will the company be able to earn a profit based on the current structure of its business, or does the company already have a viable business? Is the company capable of competing in its industry? When one is prepared to put in the effort to complete their research, there are unquestionably treasures that can be discovered that fulfill these requirements. As can be seen from the chart of GGP, Incorporated, GGP, the share price of the company saw a catastrophic decline that brought it into the category of penny stocks during the financial crisis that occurred in 2008. Up until Brookfield Property Partners bought it in 2018. GGP was a real estate company that owned, ran, leased, and rebuilt properties like regional malls. For individuals who are not familiar with the company, some information is provided. 1. Investors who kept a close eye on the share structure, fundamentals that lie beneath the surface, and competition might have been able to recognize GGP as a prime prospect and profit from a tremendous gain in the years that followed. There are specific industries that are more likely to have stocks that trade for less than $1, which is another important aspect to take into consideration. A good illustration of this is the fact that the mining and metals industry is well known for the large number of businesses that deal in pennies. As a result of the dependency on issuing new shares to acquire capital to support operations, the increased competitiveness, and the aggressive incentive schemes, it is very vital for investors to pay attention to the aspects that have been discussed above in order to achieve success. Those who are willing to put forth the effort to complete their homework will be able to identify winners. When retail traders examine a penny stock, they frequently fail to take into account the fundamentals that lie beneath the surface, such as the total number of shares that are being traded. As is the case with all types of investing, it is essential to investigate the fundamentals that underlie a firm and to supplement this knowledge with specifics. For example, it is essential to determine the degree to which the shares are being diluted through the use of stock splits, stock options, and the issuance of additional shares in order to raise capital. Outro. That's the end of the video. I hope you liked it. If you did, let me know by giving it a thumbs up. And do not forget to subscribe. Thanks for watching. See you next time.